Welcome to the Foss & Company podcast, Tax Credits Today. My name is Audrey McCormack, and I'm an operations associate on Foss's Renewable Energy and Sustainable Technologies team. Today's topic of discussion is renewable energy credits, or RECs, and how they can be paired with tax equity investment to address corporate tax liability and sustainability goals. Joining me today is my colleague Spencer Tweed, who is our Vice President of Project Finance on the Renewables team. Spencer, thanks for joining me for this conversation. Can you share a little bit about your background and what you do here at Foss?
Yeah, thanks, Audrey. Happy to be here. I'm Spencer Tweed. I'm the VP of Project Finance here on the Foss Climate team, and I've been in the industry for 8 years. My background is in renewables investment banking, helping sponsors to source corporate capital, and in project finance, working with utility scale developers to finance large utility scale wind and solar projects across the United States. And it's been an exciting few years in the renewables industry as the offtake markets and tax equity markets have evolved and responded to the IRA. So first, let's discuss RECs. The federal government has taken strong action on climate change, and we've seen industries and corporations who want to be good corporate citizens analyzing their carbon footprint and working towards carbon neutrality to reduce not only their Scope 2 emissions through REC agreements with renewables projects, but also their Scope 1 and Scope 3 emissions. So today, while we're focusing on REC agreements that can be used to offset Scope 2 emissions and how a REC agreement can become part of a tax equity transaction.
Great. Thanks so much. And just to back up slightly for those who might not know, can you just give us a real quick overview of what a tax equity investment is?
Yes. A tax equity investment is the process of structuring an investor with a corporate tax liability directly into a renewable energy project. And to me, the easiest way to think about it is the investor contributes cash to a renewable energy project and in return receives 99% of the investment tax credit, the majority of the depreciation, and some portion of cash from the project over a 5 to 6 year investment term. And as you know, the structuring can be complicated. And Foss has been a market leader in tax equity transactions since the 80s and has been active in the renewables market for 5 years. So we have an experienced team who can manage the complexities of these transactions across the commercial, legal, accounting, reporting, and all the other elements that are part of these transactions.
And what kind of technologies do we typically work with on the renewables team? And then where can investors expect to see RECs or renewable energy credits developed or generated?
Yeah, that's a really good question. So at Foss on the climate team, we're primarily focused on 4 different kinds of technology. Traditionally, we participated in standalone solar tax equity transactions. So think large utility scale projects and smaller DG and community solar systems. We're active in utility scale wind projects where the PTC is an option. We're active in standalone storage. I would note that right now, standalone storage doesn't qualify for RECs, and we're active in the carbon capture space. To the extent we're partnering up investors who want to invest in RECs, most of the opportunities that we've seen in the market have been either through utility scale wind or utility scale solar projects.
Great. And then before we talk about some of the trends that we're seeing in the market today that you can shed some insight into, can you quickly touch on the concept of, what creates a REC in the sense of additionality? What does that mean, and how does that contribute to maybe a corporation's sustainability goals?
Yeah, let me provide some context on why corporations want to participate in the REC market. So it may be worth to start qualifying the difference between voluntary and compliance RECs to set the stage. Compliance RECs are governed by different regulatory jurisdictions set by RPS compliance standards. And these buyers are typically utilities and electric resellers or suppliers that have to abide by the standard. Our primary market is corporate customers who are participating in the voluntary REC market. So this means there isn't a regulatory requirement forcing compliance, and these corporations can purchase renewable energy credits from qualified renewable projects, like we were saying earlier, wind and solar, and they can report reduced greenhouse gas emissions associated with electricity consumption. And these lower emissions in turn inform accounting allowing the corporations to report lower emissions while their actual electricity consumption is unchanged. And I'd just like to note that traditionally the corporate PPA market has been the primary mechanism where corporates will execute bundled PPAs where the off-takers agree to purchase the energy and the renewable energy credits generated by the project. We've seen a recent trend with some of our corporate investors in the tax equity space who want to participate in the voluntary REC market without entering into a power purchase agreement as they look forward to their near, medium, and long-term corporate ESG goals to offset Scope 2 emissions.
So looking at those new trends that you just mentioned, how might we structure a deal in where we're not necessarily utilizing a bundled PPA where the RECs are included? How does that look with tax equity and the purchase of RECs side by side?
So this is something of a new structure, and we're still working through this right now, but the intent is to have a traditional tax equity structure, so either a partnership or inverted lease, and then a separate standalone REC agreement that the tax equity investor will enter into with the project. So think of them as two different transactions that occur simultaneously. And there's some threading of the needle here because typically investor appetite to deploy tax equity and demand for RECs won't conform to the same project. So just to give an example, if an investor wants to deploy 100 million of tax equity, if you assume the corresponding project is around 250 megawatts, depending on where it's located, it's probably generating somewhere between 425,000 and 450,000 RECs a year. So to the extent the investor requires fewer RECs, we can size the REC contract to be less than the expected generation. If the investor wants more RECs than the corresponding investment amount, we can work with the sponsor to either source RECs from other projects in the sponsor's operating fleet, or we can establish some sort of ramp period to round out the balance as future projects from the sponsor's portfolio comes online.
So from an incentive standpoint, what's the incentive look like to the sponsor versus the investor as to why they would want to participate in a structure like this?
So I think the pitch to the sponsor is tax equity is becoming increasingly scarce. And we have a network of credit-rated investors who are eager to participate in project finance transactions. And this allows the sponsor to avoid the transfer market, and they can more easily effectuate the step up and monetize the depreciation. And just to add a little bit more context here, pre-IRA, the market for tax equity was around 17 to 19 billion a year for the ITC and the PTC. And I think it still remains to be seen exactly post-IRA, exactly how much tax equity demand is out there from sponsors. But I've seen estimates that range from 40 billion a year to as much as 80 billion a year. And I know that the topic of conversation today isn't the transfer market, but one of the ways that we're able to effectively get there and monetize all those credits is going to be through the transfer fees. But what we've seen is top tier sponsors still prefer traditional tax equity structures because they're able to effectuate a step up and they're also able to monetize the depreciation with the tax equity investor. So ultimately the economics to the sponsor look much better in a tax equity transaction. And to the extent they aren't able to secure tax equity, this is a mechanism that allows them to access a certain portion of the investor market that isn't available to projects that have already signed REC agreements.
Okay, and what's the incentive to investors?
Yeah, so to me, I think it's twofold. I think first is we can use tax equity as a mechanism to lock down RECs from projects that have been heavily diligenced by the FOSS team. And we can go to the investor with a straight face and say, these projects have reliable generation profiles. We're familiar with the sponsor. We're familiar with the technology. And we're confident that the generation profile that's forecasted in the REC delivery that's been promised is accurate, and there's a high level of reliability that the investors can rely on, knowing that there's been that additional level of diligence from FOSS. And then second, there's a timing issue to consider. So, typically sponsors are soliciting tax equity around the same time as NTP. So that's when these projects are shovel ready and kicking off construction. So usually it's anywhere from 6 months to 12 months ahead of COD or placed in service. And granted, there's still construction risk, but there's a higher degree of confidence that the projects will deliver RECs on schedule. Whereas for folks who are signing up corporate PPAs, those can be signed up 1, 2, even 3 years ahead of target commercial operations date, which leaves the door open to unseen project delays. And this can become a real concern for investors because they have their internal ESG goals and they want to be able to offset their greenhouse emissions. So to the extent they can have that higher degree of confidence and certainty when they're going to their ESG committees to say, yes, we're confident that this project is going to be placed in service and that the RECs are going to be delivered when we expect them to be, it's a huge benefit for the investors who are also entering into these REC agreements.
Great, thanks for that. As we know, the regulatory landscape has been shifting in the United States. We have the SEC rule that we're expecting to see come out soon. We have new regulation in California that's going to require reporting on scope 1s and 2s, as well as 3s shortly thereafter. As you said, there's a little bit of a lead time for investors to be able to claim these RECs. What is advice you would give now for an investor that's looking to get ahead of these changing regulations?
Oh, that's a great question. So, yeah, my advice to investors who want to sign up REC agreements, whether or not they choose to participate in tax equity, is that they need to start looking now at their 2025, 2028, 2030, and beyond corporate goals and start engaging in the market. Here, I think one of the levers you have coming in as tax equity is that you have an opportunity to form a relationship with a handful, maybe even only one sponsor who has visibility into what their pipeline is over the next couple of years. And you can work together to actually figure out, how many RECs are available from projects that are coming online in the next couple of years, and how does that correspond to the investor's need. A lot of the investors that we've spoken to in the space, they have ramping demand, meaning, so just to give an example, right? They may only require, say, 100,000 RECs in 2025, but by 2030, they want to have over 500,000 RECs delivered per year. And the sooner you can start those conversations with sponsors, the better positioned you are, because I think one, with the changing landscape and with stricter requirements, that there will be upward pressure on the cost of RECs. So to the extent you can enter into REC agreements now, that's to the benefit of these purchasers. And two, by forming these relationships directly with sponsors through the tax equity mechanism, you get a first look at premium projects, and you can really have a high degree of confidence that as you're moving forward, you know that those RECs are going to be delivered. Typically, the pipelines that these sponsors have are far greater than the actual need that most of our corporate customers demand. So to the extent certain projects drop out, things come up during permitting or the interconnection process, there are other projects in the sponsor's pipeline that they can use to backfill to ensure that the REC purchaser is able to receive those RECs when those RECs are expected.
Great, thank you. And as far as, what we typically see at FOSS, what's the investor profile that we're usually seeing? And has that shifted alongside, the changing landscape, the trends that you mentioned earlier? Are we seeing our typical investor profile shift from one to another? Are investor priorities changing?
I would say the type of investor hasn't changed. So historically, the major tech companies have been at the forefront of participating in these voluntary REC programs. what we have seen change, I'd say, over the last 12, 24 months is more and more companies who sit outside the technology vertical are interested in participating in rec markets. So we have had discussions with Fortune 500 companies of all different kinds who are interested in learning more about rec markets. And also on the heels of the IRA, they're more interested in learning how they can participate in tax equity. So yeah, there has been a shift where while the major tech companies are still at the forefront, we've seen all different kinds of corporates come to us asking questions around how they can participate in rec markets, what sort of projects are available, and also how they can participate in tax equity to receive a return on their tax appetite to support the rec market. I think, on the structuring side, one thing that's really interesting to note is typically there's enough cash flow coming off of these projects that the cash flow is greater than the value of the rec agreement. So you can actually use the cash from the tax equity investment that's paid through the preferred return, or in an inverted lease through the preferred return and the residual cash flow, to pay for the recs. So ultimately, those recs can be viewed as economically neutral through the tax equity investment.
And just working alongside you at FOSS on the renewables team, I think we're always learning, always trying to keep up with a constantly shifting landscape. But for investors that are looking to get into this space, whether it just be traditional tax equity investment or tax equity with recs, what kind of expertise can we offer them at this point, and who would you encourage to reach out to us?
Oh, that's a great question. Yeah, so as I mentioned earlier, FOSS has been a leader in tax equity transactions since the 80s, and we've been active specifically in the renewables market for 5 years. And our team is very experienced. We have a deep understanding of everything that goes into these transactions. So that includes commercial, legal, accounting, and reporting requirements. And investors who come to FOSS can be confident that typically by the time we present an opportunity to the investor, it's already been screened and we've already done a preliminary level of diligence. So they know that whoever they're partnering with on the other side is going to be an experienced sponsor, and it's going to be a very, very high quality project. And further, once the project's operational, because of the way that we're structured, we have a full portfolio management team who manages all of the ongoing reporting and accounting requirements associated with the transaction. Anyone who's interested in participating in this market should reach out either to myself or to Brian Alperin, who runs the group, to learn more about these opportunities and how they can partner with FOSS to participate in the tax equity market, either as a standalone investment or partnered with rec agreements.
Thanks so much for this discussion, Spencer. It's been really interesting. I think hopefully there's something for everyone. I think we covered some of the more basic concepts as well as kind of more into the weeds for those more seasoned and more experienced listeners in the tax equity space. Again, if anyone has any questions at all, please reach out to our team. Any final comments from you, Spencer?
No, this has been great. Thanks for having me on, and I'm looking forward to coming back in the future.
Thanks.